Well, I guess it depends which market you're talking about, because one of the challenges right now is different markets are sending very clearly different signals. I mean, if you look at the yield curves in the U.S. and elsewhere, it's saying a recession is coming, whereas you wouldn't expect a rally in equities when the recession hasn't actually arrived yet. So it depends on which market you think is right. We're more on the bond market side, thinking things are going to slow down more than the market has priced in, and for us, that makes us cautious towards equities.
But bond markets have certainly been ones to kind of look into with keen interest now, right? Because they're actually offering some really good return.
Oh, absolutely. And I think this is going to be the return of the bond market, if you will. At a minimum, you're going to get coupon, you're going to get interest income that you haven't had clearly for quite a long time, in Europe as well, so we can remember the last time that happened. In addition to expect volatility, of course, in yields, but ultimately expecting yields to be lower at the end of the year, because the Fed will at some point start lowering rates, and so you're going to get some price appreciation as well. So that's quite attractive when you put that against this optimism that's priced into equities. Even though we've had a lot of declines, we think there's a risk for more.
Yeah. You've noted that you're keenly interested in the bond market, but would you call this time a time for asset allocation, or rather asset accumulation then as well? I mean, we are still set for higher rates, and just not sure how much. If Madame Lagarde is to be believed, it's still 50 basis point hikes on the way, and not necessarily the 25 we could be looking at.
Well, that's one of the interesting questions for the market right now. You see both in the Eurozone and in the U.S. this expectation that inflation is going to decelerate quite quickly by the end of the year, 2% in the U.S., 2.5% or so, a bit higher in the Eurozone. And that's what then allows the central bank supposedly to begin cutting rates in the summer, again, also in the Eurozone. But if you look at core inflation in the Eurozone, it's still going up. So maybe you think that can happen in the U.S. because core inflation has actually been falling. It's not in the Eurozone. So again, another reason to be quite cautious about the optimism you see, at least as far as inflation expectations and policy rates.
Is that 2% even feasible, though? I mean, that 2.5% inflation rate. Let's go U.S. Let's start in the U.S. I mean, does that even look feasible considering where we are? The pull down and the slowdown doesn't seem to be as prodigious as they had hoped, of course. Maybe they've underestimated a softer landing as well. So does that mean we take a little longer to get to 2%, or should we even be re-looking at what a base case for inflation should be?
We think we'll get to 2%, not by the end of the year. You're exactly right to think the markets, well, I guess it depends what you think is behind the market's assumption that we get to 2%. There's either this very benign soft landing scenario where what we see saying goods inflation, where we do have disinflation, we have falling prices, that continues, it spreads to the other components, and voila, we're at 2% by the end of the year, we're all happy. The alternative and less benign scenario is that happens because we do get the recession, and that certainly is going to bring down inflation, but in a not particularly positive way for risk assets. So it's not only that forecast, which you can agree or disagree with, but also what you think leads you to that number.